money. So what I want to talk about today, and the main reason I had another speech in mind, but I didn't have enough time to prepare, so I want to do something I can talk on at the spur of the moment, and the European debt crisis is it. What I want to talk about a little bit about how we got here the first fall, what is going on now, and how it impacts us. So the first thing is, how did we get here exactly? The first thing to know is that the EU, the European Union, is made up of 27 countries in the European area. The reason why it's formed actually started back in 1957 with a core group of countries, and then it added countries on and on. The main thing is that when the Soviet Union fell, it started adding a lot of Eastern European countries and Southern European countries. The reason for it is that Europe, as you can see, it's not like the United States, which is one great big country. It's a lot of little bitty countries, and they all speak different languages. They all have separate economies. And the idea of the European Union is, let's take all these countries and enlarge our purchasing power, enlarge our economies of scale, so that we can compete worldwide. So what happened is they adopted the same currency. Now this is a really, really cool thing in many ways. Because now you can go from France and you can take your good that you made in France and you can sell it over here in Germany and you can sell it for the exact same price in France and it'll buy the exact same good in France or in Italy or in the Czech Republic. You can have the prices stay the same throughout that entire area. That is really great for people who want a bigger market than just their little local market. And they'll know exactly how much they're going to get and how much they're going to be able to charge. And it's an area over 300 million people. So this is a great, great idea in many, many ways. But here's the issue, is that what happened is these countries didn't want to give away their autonomy. And I can understand that. So the federal governments for each of these countries kept their money supply. They kept, not their money supply, they kept their national budgets intact. Now there were guidelines, right? There were targets. They tried to say, all right, in order for you to be in the EU, you need to only have this much debt. You're only allowed to have this much national debt, and then you can still borrow on the euro, and you can get the same interest rate that all the countries could get. Well, this worked really, really well until the debacle of 2008. At that time, as you're aware, the Lehman Brothers went bankrupt, and it created a huge credit crisis throughout the world. There are some underlying factors that are obviously too complex to go into. But just understand that there are a lot of people handling a lot of money that all of a sudden were not worth as much as they used to be. There's a lot of debt out there that people couldn't pay. And so what you have is a situation, these are all the 27 countries. There's a couple of really important ones. Germany has, and you can't really see it on this, but it has 82 million people. Britain has 62 million. France has 65 million. These are some of the most important countries in the EU. On this one, so this is the debt to GDP ratio of the various European countries. And what you'll see on here is, has anybody ever heard the term PIGS? Okay, great. What it is it's an acronym for Portugal, Ireland, Italy, Greece, and Spain. And you'll see on here, Greece has a ratio of 165% debt over GDP. Italy at 120, Ireland 108, Portugal at 107, and then Spain is way down here at 68.5. And so you wouldn't think it would be a part of that group, but I'll show you a little bit about why that happened. Here's the really interesting thing. You'd think with all the news that Greece must be the most indebted country in the world. But here's one thing, and it's kind of ironic given who just spoke. Actually, the most indebted country in the world from GDP, when you compare GDP to from GDP to your debt ratio, is actually Japan. And Japan is at, you saw where Greece is at 165, Japan is all the way at 211. But there's a difference between the two. Not only is Greece actually a part of the EU, so they can't print money the way that Japan could, but also Japan is one of the most insular countries in the world. And so actually Japan owes its debt to Japanese citizens. There aren't any real external people coming in there and buying Japanese debt because they're not really allowed, either legally or socially. They don't want to sell their debt to foreign countries. Whereas Greece is owned by all the different countries in the EU, it's owned by Chinese, it's owned by Americans, and so they put a lot more pressure on Greece to change their ways. It doesn't mean that Japan is okay. They're in a lot of trouble because they're in that much debt, but they're in trouble with their own citizens for the most part. Here's the thing I want to point out, though, is look at the United States here. The United States started in 2007 at 67%, and then has gone up to 69, 89, 98, and 103. It's actually worse than places like Iceland, which actually had a default, and some of the other countries. And if it keeps going up, we're going to be in the same kind of trouble that other countries are. But there's a big difference. And the big difference is we have a military that can blow anyone the hell out. And so no one's going to put quite the same pressure. Also, do you know what the safest investment in the world is considered right now? Does anybody throw something out? Well, aside from gold.
U.S. Treasury.
It's a 30-year Treasury bond or the 10-year Treasury bond. Those are considered the safest investments in the world. And so as long as that's true, we can continue to pile up debt, and if foreigners are willing to buy our debt, then we're going to be in good shape. The problem is that it doesn't happen like slowly. You all of a sudden fall off a cliff. And so one day we may wake up and investors aren't willing to buy our debt anymore, and so our interest rates run sky high, the way they have for countries like Greece and Ireland and Spain and Italy and Ireland. So how does it impact us? The main way that it impacts us is that Europe is a huge consumer area for us. And so if these people can't afford to buy our goods, we're not going to be able to sell them to anybody. We're not going to be able to make any money from them. And so it's going to make us lose more jobs. It's going to make us not be able to buy as many products. And it's a real fear right now. It's a legitimate fear. And you see companies start to cut back because they think that may happen. So here's the key thing. If I owe you £1, I have a problem. But if I owe you $1 million, the problem is yours. And that's the issue we have right now, is that, frankly, there's a lot of countries that owe a lot of people a lot of money, and frankly, it's become the problem of the creditors, and so we're all trying to sort it out. I have a very, very dim view of how well we sort it out, but that's kind of the issue that we're facing in a nutshell. Madam Toastmaster.